Joining us there from Riyadh. So I guess the first very obvious question is, what's the attraction? What specifically takes Schroders to Riyadh?
Well, there's a very major conference here being sponsored by the Crown Prince. And there are about 3,500 people here. And the Saudis are laying out their plans for the next 3 or 4 years through 2020, and then the next 13 years through 2030. And there's some very, very major adjustments happening here to the economy, setting up a major new sovereign wealth fund. So it's a fascinating time to be here, and I think it represents a new direction for the kingdom, and I think some very real opportunities.
Michael, we caught up with the Blackstone chairman a little bit earlier, and he came home from Saudi a couple of months ago with $20 billion of new commitments for infrastructure. Have you had substantive discussions with the PIF or any other Saudi institutions? Have you won any new business on this trip? Any new commitments for Schroders?
Well, we have an existing a set of clients here who are very important to us and have done for, I guess, 20 years or so. So we have very good relationships here with the government and other parties, and we look forward to deepening them. But I'm not certainly putting a number on anything, unlike Steve Schwarzman.
OK, we won't drag you down that road then, Michael. We'll leave that one. Now, you've been at Schroders, of course, since, 2001. Wondered if you could reflect on the changing nature of the industry. We just talked to the Vontobel management about whether we were reaching peak passive. He said it's very difficult to say. In an environment of passive versus active, how profitable can this line of business be? How profitable can your industry be with that as the backdrop?
Well, there's obviously been for 15 years, there's nothing new about this growth in passive. It's been going on for 15 or 20 years, and it continues, and I think it probably will continue further, because passive, particularly for major institutions, has an important part to play. But even during that time, active managers have done very well, and they continue to do very well, and I think the opportunities for active management are significant. We're probably in a market environment now where, in fact, there are opportunities to outperform. I think you've seen that across the board in equities and fixed income. A lot of active managers have delivered excess returns, and I think that could continue. So my view would be that maybe this sort of exponential growth in passive will tail off a little bit, and I think there remain great opportunities for active managers, and it's obviously a very profitable industry with very high rates of return on equity and good profit margins. Now, that's probably going to come down a bit. I think that's well flagged in the market, because fees are reducing because of things like MiFID II, because of regulatory pressures, quite rightly. And I think a lot of managers are sharing the benefits of scale with their clients. So I think fees they have come down quite a bit, and I think they'll probably go further. But that still leaves, I think, a great growth opportunity for active as well as passive managers.
Can I ask you then, Michael, obviously we've had a lot of active management activity this year, particularly in some of the Dutch companies. Paul Singer was warning that passive investing is a danger to devouring capitalism. Would you encourage fund managers to be more vocal with the companies that they invest in?
Well, it's happening. I mean, governance and involvement with companies is at a very high level. I think that's quite right. It's actually, that's not only true of active managers, it's true of passive managers as well. People are getting actively involved with the companies in which they invest, because they think that by so doing, in the long run, they're going to generate higher returns. If they become active fiduciaries in that sense. So I think that's been happening quite a while. It's going to continue. I think it's correct and positive, and actually it's happening in the passive universe as much as the active.
Can I ask a little bit about artificial intelligence? We were just having a conversation with another asset manager who was saying that there's always going to be a place for savoir-faire, knowing how to get things done, and that's not necessarily something that you can lead, in his words, to the guys in sneakers. I think that was his way of describing computers and artificial intelligence. How is Schroders keeping ahead of that particular trend in the industry?
Well, we're investing a lot in data and improving our capabilities in this area, and it's a big thrust for what we're doing. And Peter Harrison, the chief executive, is is very committed to that, and I think absolutely right. So it's becoming a much bigger part of what we do, and I think will continue in the future. Having said that, it's how you interpret the data that matters, and collecting it is one thing. Interpreting it and making it effective and impactful in your investment decisions is quite another, and there, the sort of human interplay is absolutely critical. So I think it's a combination. We're not. We still think absolutely that talent, experience, great investors are going to be as critical in the future as they have been in the past. But the tools they're going to have through AI and data and so on are going to be much greater and I think more extensive.
It's good to know there's still room for the man and woman with a voice in this business. Michael, can I ask you, we know from your CEO, Peter Harrison, that there may be an interest in terms of expansion in the United States of America. As the chairman of Schroders, where are you encouraging Harrison and the team to look? Are you encouraging M&A? Will there be more consolidation for you and Schroders?
Well, the industry's been consolidating for a long time. Again, it's going back 10 or 15 years. That, I think, will continue. I think, costs are increasing. As we said earlier, fees are, to some extent, reducing. And I think people are looking for scale benefits. And that can be achieved through organic growth, which is what Schroders has largely done. But it can also be, to some extent, achieved through acquisitions. So I think the industry will continue to consolidate, and Schroders will be a part of that, but rather differently to many others, because where we look to grow through acquisition is through basically talent-based opportunities. We're not just seeking to add scale for the sake of it. We're looking for talent for complementary areas which can help us help our existing organic growth extend further or more rapidly, but very much in talent-based deals. And the transactions we've done have typically been not huge, individually very, very important, and I think add diversification and growth opportunities. But they're not the sort of big industrial type transactions that some others have done. And I think that will probably continue.
OK, so that continues. Michael, on another subject, a lot of central banking decisions being made as we head towards the end of the year, and the Bank of England very much in focus. If we see the Bank of England turn tail and start to hike rates, as has been the suggestion, would that be a mistake given what we see in the underlying UK economy, or the right move?
Well, I think we've seen somewhat conflicting messages coming out of the bank, and recently a suggestion that they will be looking to put up rates, and I think the decision in early November will be quite important. And it seems to me there's a sort of two-way pull here. There's high employment. There's some little tick up in inflation. On the other hand, some of the underlying economic fundamentals are not that strong, and I think some uncertainty around the Brexit negotiations is part of that. So it'll be interesting to see what the bank decides in early November, and I think there is a bit of a two-way pull. If there's a 25 basis points increase, I suspect that'll be it for a while.